Welcome back, everyone. Right, question from Michael. Is there any reason why the strategy can't be done with options? If so, how far out would you suggest? 2 weeks, 2 months, etc. Okay, so there's no reason why the strategy can't be used with options. The reason why I'm not at this stage using options for my own challenge is because of the small account balance that I'm starting with. I'm giving myself a $1,000 start, and I want to try and get that to $100,000. I will move over to options probably later on in the year with this strategy. It's not essential right now. If you have the means and the opportunity to, with a slightly larger starting account, you can certainly use options. You can use option. I would be reluctant to use spreads. Yeah, you've got pattern day trader rule as well, Sean. You've got certain restrictions. If you're going to, again, use options, you're going to get, between 1 and 3 signals a week. It might be better to consider, and to be fair, this is the one thing that I hadn't actually mentioned yet. When you start out, you're trading signal to signal. So pattern day trader shouldn't be an issue, in fairness, Sean, because you're always going to hold overnight. So it shouldn't be an issue. It's only going to be an issue if you're trading multiple instruments, because the chances of you opening and closing on the same day would increase, either accidentally or for, being whipped in and out of signals. Again, that would only happen if you're trading double figure instruments, 12, 13, 14 positions on multiple different instruments. So it is, again, it is possible, but it's unlikely at this early stage. To be fair, you can do it. It depends. Not everyone has large accounts balance, Michael. So it just depends. I want to take $1,000 to $100,000. $1,000 with even with options, it gives me restrictions. My per trade risk on the volatility that I want to trade is not there. Yeah, this is what I was trying to explain earlier, Michael. It comes down to volatility. I want high volatility on the price movements because I want to get paid faster. Now, the sacrifice of trading, for example, stock options, is you need to trade smaller size stocks with lower volatility, not just price volatility, but also option volatility. So what's going to happen is the risk to profit ratio is going to be smaller. And it means it would take me longer to get where I want to be. So this is what I was trying to explain earlier. I want price volatility. I want range of movement. I want to get paid fast on a small account with low per trade risk. And I can't get that with options. Yeah, so again, and you raise a point as well there, Sean. What I want to do is later on move on to something like that later. But it's not the objective for the early stages. Again, you can trade, if you want to trade individual stocks or ETFs, that's fine. If you've got the means and the ability to trade stock options, then by all means, go for it. I'm not saying don't. You've got to figure out what's most relevant to you. The other thing that, to be fair, if you have got the ability to use stock options as a choice for your own personal challenge, you don't have to worry about stop loss as such because it's all on entry risk management. So the stress levels will be lower if you've got the ability to do it at this stage. It's just not the focus of the early stages of my own challenge. You can, to be fair, Michael, you can trade CFDs. You've got to find a broker somewhere else in the world. You're not going to find a US-based broker, but there are brokers all around the world. The one I mentioned earlier will accept US residents. But in fairness, if you've got the ability, by all means, you can trade stock options. If individual or single puts and calls is not viable, certainly option spreads. Again, think about the trade-off. The trade-off is if you do go down that road with options, it's going to be maybe a slightly slower path to your $100,000 challenge because your situation, your circumstances, your ability, your means is going to be a little bit different. It might mean that you have to trade lower volatility stocks and ETFs. That's not a problem. Just understand the situation that you find yourself in. Random sidebar before we dip into the mechanical entries. One of the hedge funds that I coached and mentored through starting up hedge fund actually uses this methodology with options in their hedge fund. So you can use it. You can use this methodology with stock options. Yeah, I think I know. Choices. The broker that I mentioned earlier will accept US residents and allow them to trade CFDs. What's called turnkey forex. Again, there's plenty of brokers all around the world that will accept US residents. To be fair, I can't comment on all of them, simply because I can't, both physically and legally. I can only tell you like one of the other members suggested turnkey forex. I'm using plus 500s. To say anything else technically is financial advice, and I could get into a little bit of trouble with it. So I literally can't, but practically I can't anyway, because there are thousands of brokers that do accept US residents. You're going to have to find the one that makes sense to you, your personal situation, and your situation and circumstances. Right, with that said, mechanical entries. This is what I call the shotgun entry method. Now, I'm using CFDs, as we've just mentioned. You can use spread betting if you're in the UK or Europe. You can use single stocks. You can use options with all of this process. I'm going to be focused on CFDs, but the principles apply exactly the same for spread betting and exactly the same for stock. It's a little bit different for options trading. The purpose of this challenge is not to teach you how to trade options. I do have a different program for that, but this isn't the purpose of it. I'm going to be focused on CFDs, spread betting, and stock or ETF trading. That's the focus of this trading, and that's what the mechanical entries, and the discretionary entries and exits, that's what they're going to be based around. So mechanical entries, the shotgun entry method. This is the predominantly the method I'm using for my own challenge. We've actually already been through the discretionary entry method, unbeknownst to you, but we will recover it in more detail in just a moment. So mechanical entry method. Mechanical entry method. Let's zoom in again. I'm just going to focus on the previous or a previous week. Get that all in. So this is just one week's worth of trading. I'm going to pick a good week, and then I'm going to pick a not so good week so we can see the contrast. The week before last, 2 weeks ago now, is the week I'm going to start with to illustrate the process. We're then going to look at last week, which highlights, in fairness, a shitty week. So you can see what a really good week looks like and what a really bad week looks like. Alan, it's going to be a slow process. Just to answer your question, can we reach $100,000 with $1,000 trading ETFs? No one can say no. No one can say yes. It's not the best answer in the world, Alan. It's possible. Will you do it? I don't know. Could I do it? Yeah, I could probably do it. But then I've got 20 years experience. Again, the purpose is not to trade. My apologies, Alan. I misread your question. I thought we were talking about options. It can be done with ETFs. Yes, you can do it similarly. To be fair, let's just go over to, so the S&P futures is what I'm trading with CFDs. Again, my apologies, Alan. I misread your question. If you take a look at SPY, Sierra Papa Yankee, SPY. This is the ETF, the exchange traded fund for the S&P 500. I'm focusing on the futures chart and the futures data and futures prices. This is the stock equivalent of the same thing. You can trade it in your brokerage account in the same way using what is essentially shares, the ETF, the share traded version of the same instruments. Again, let me just zoom out. You'll notice, first of all, that there's less candles. So now I'm looking at the last 3 weeks. On the futures chart, you have overnight trading. The futures chart is effectively 24 hours. The ETF version is only going to be open for the regular US stock market hours, but visually you can see you've got the same trades. You're going to have a little bit of less data because there's no overnight trading. It trades like a stock. So you could trade it with ETFs. If you want to trade, 1 or 5 shares or 10 shares or 50 shares or, whatever makes sense for your personal situation, you can certainly do that. I would suggest if you're going to trade stocks on ETFs, I would suggest the discretionary entry method, which we're going to go to after the mechanical. And I'll explain the reasons when we go through that, but I would recommend that if you're going to go through the individual stocks and shares. Again, the primary reason is that it's not open 24 hours, and you're unlikely to have the ability. So yeah, the discretionary entry method would make sense. Again, to be fair, you already know how to trade the discretionary method. I've actually already gone through it, so it might be a little bit easier for some people. But nevertheless, that's what I would suggest. We'll come back to that in a moment. I lost my place. Where were we? Last week we were going to go through, previous week. So we're going to go through a good week first of all. Right, shotgun entry method. This process, the shotgun entry method, allows me to not be at the computer to place my orders. Now, the discretionary method, you just need to be at the computer once, and you would need to check in, again, still just once a day, in fairness. The mechanical entry method, as long as the direction hasn't changed, I don't need to look at the charts. Does that make sense? So I'm just trying to emphasize there's not much difference between the two. The mechanical entry method, there's automatic compounding. As you'll see in a moment, they're all predefined entry levels. The discretionary entry method requires you to trade pullbacks. We'll go through that later. And the compounding is, as the name suggests, it's discretionary. It depends on what sets up in the markets. There's no better method. Personal preference, if you want to choose one over the other. I want to be aggressive. As I've already kind of illustrated earlier, I am being aggressive in my trading, but it's still very passive. So I'm choosing mechanical. It means that I'm not at the computer. As long as the direction doesn't change, we're cool. I'm aggressively compounding, which we'll explain in a moment, and I'm looking for at least 50% of the average week's move. I'll pause there. Mechanical entry method, benefits, less screen time. It allows me to be a bit more aggressive and compound into favorable movements. The downsides are it's mechanical. I'm aggressively compounding into movements. That's a downside, which we'll see in a moment, because the stops are exceptionally small, and it means it's a little bit whippy. What I mean by whippy is I could get in an entry and stopped out quite quickly, but I don't need to be at the computer to replace the order. As long as I've got access on my mobile phone. Last week was a very whippy week. This week that we're going to look at, which is the week before, was very quiet and relaxed. There is several stop outs. Again, this is the downside to the mechanical method. If you are concerned about being stopped out multiple times, and stopped out just means that you've appreciated a small loss. You've got in the position, your position has then been closed. That's what stop out is. I refer to it occasionally as a whip. You've been whipped in and whipped out the markets. And the reason is that the stop loss is exceptionally small. I'm happy to take lots of small losses for the chance of compounding in to a big move. That's the trade-off. So this method has advantages, it has disadvantages. Again, just to emphasize, I'm using it because I want the compounding ability and the mechanical entry method that comes with that, because I want to be aggressively compounding into a movement. So with that said, let's go and look at mechanical entry methods. So we've got our alerts, we've got the bearish indication, we've got the bullish indication, we've got our pullback entry there. So is everyone happy with the alert? I think it's pretty straightforward, but everyone's happy with the fact that price needs to go above that level for our new number one, number two conditions to be met. Cross, pullback, there's the pullback high. I think everyone's happy that price needs to go above that level for a bullish direction to be confirmed. So how do we actually enter into the movement with a mechanical entry method? So I want to take that number, that pullback high. So that is 2613. So that's the price of the pullback high. So my entries are going to be above the pullback high. Now, the mechanical entry method, the shock, you'll start to see what's called the shotgun entry method after the pros and cons explanation. It's whippy. I'm going to get stopped out a lot. It's a shotgun approach. I'm going to put it's not necessarily spray and pray, but again, it's got advantages, it's got disadvantages. Advantages allows me to compound quite heavily into movements, and the pros for me, the profits, the pros outweigh the losses, which is it's a little bit whippy. It involves picking a predetermined level above the pullback high. So the pullback high is 2613. I am going to use the whole numbers above the pullback high. So a whole number on the S&P would be 2620. So I'm going to pick 2620. So that would be above the pullback high, which is 2613. I want to pick the whole number above that, which is 2620. Does everyone get that? Before we move on. So that's the whole number. So a whole number would be 20, 30, 40, 50, 60, 70, 80, 90, double O's. Nice and simple. I'm using a principle that's been around for hundreds of years. I'm taking advantage of whole numbers. Now on the Dow, it would be every 100 points. On Facebook, it would be every $1. Or on individual stocks, it would be every $1. I'm looking to take advantage of the whole numbers. So on the S&P, 2620, 30, 40, 50, 60, 70, 80, 90, double O's and tens. On the Dow, it would be every 100 points. On individual stocks and ETFs, it would be every $1. On Forex currencies, every 100 pips. If you're not trading currencies, don't worry about it. But every 100 pips, if that makes sense, great. If it doesn't, don't worry about it. What else have we missed? But yeah, every whole number increment. So let's continue. So my entry is going to be around the whole numbers. Let me just do this again. So 2613. So 2620 is my whole number. So I'm going to enter at 261 and the stop loss is going to be 18. So let me just do this. So the first number is 2620. So I'm going to enter at 21 with a stop loss at 18, and that's a 3-point stop loss. Michael, that's absolutely correct. To start with, you're going to pick one. You are trading signal to signal. You're not jumping around from stock to stock to ETF, from instrument to instrument. You're absolutely right. My apologies if that wasn't clear earlier on. You pick one to start with. I'm trading signal to signal and I'm building my account. And that might explain my earlier comments of why I'm picking a price volatile instrument. Because I'm trading one instrument, I want to maximize the trading from it by trading a volatile, a stock or an instrument with price volatility. So S&P, I'm trading CFDs with this. You could trade Facebook stock. To be fair, you could, if you've got the even just a small account, maybe 5,000 or more, you could probably trade Facebook with options if you wanted to do that. You should have enough to not worry too much about risking or betting the farm. You've got small per trade risk. My apologies if that wasn't clear earlier on. So using the whole numbers, again, I'm focusing on CFDs. You could trade this with individual stocks. If you want to trade it with futures, again, if you've got if you've got $100,000 and you want to take it to $1 million, which is what we're planning with Sean next year when we've grown our accounts, that's what we're going to do after is our next challenge. But you could certainly do this on any instrument that makes sense. So 2620 is the whole number. I'm going to enter at 2621 with a stop loss at 18. It's a 3-point stop loss. On the Dow, just to give you a comparison, 3 points would be 30 points. On Facebook, the same equivalent would be 30 cents. You'll be in at the, for example, $101.10, and it would be $100.80. So it would be a 30-cent stop loss for a stock, just to give you the comparison. S&P, 3 points. Dow, 30 points. Stocks and ETFs, 30 cents. You get what I'm saying. For stocks and ETFs, because it's quite tight, again, I would probably suggest the discretionary method for stocks and ETFs, just because it's not a 24-hour market. Again, it's just personal preference more than anything. It does work, but it's just one of those little quirks of markets. So it's 3 points. So my entry is going to be above the whole number. In this case, the first whole number above the pullback high. And there's 7 points difference. I don't know if you can see that, but there's 7 points difference between the pullback high and the first round number. 7 points on the S&P, that would be like 70 Dow points. That would be like 70 cents on Facebook. So going back to one of the earlier questions where we had, do we need to worry about a few pennies here or a few pennies there if you're trading spread betting or CFDs and your charting doesn't quite match the broker's prices? Which, again, there's only a few pennies difference, if that is going to be an issue. It's not an issue is all I'm trying to say, because there's such a big difference between where the pullback high is and where the next whole number actually would be. So there's going to be a little bit of a difference between those two levels. So that's the first entry level. So entry is 2620. So when that has been tripped, which happened, which happens, so 2620 is there, that happened at that point. So that's where the 2620 level was tripped. Okay, so when that happens, I can buy. Again, I want to get in at 2631, 2641, 2651. I'm sure we can see where this is going. 2661, I'm running out of space, and 2671. So there's my 50 points. So I want to try and capture 50% of an average week's move. I'm compounding in every 10 points at the whole numbers, getting in at the ones and out at the eights with a 3 points stop loss. I'm aiming for a 50-point move, and I'm compounding in this case, every 10 points. On the Dow, it would be every 100 points. On something like Facebook, it would be every $1. Overall, it's bullish. And you're going to be bullish until a new direction has confirmed, which is step number one. Step number two. Wait for the cross, trade the pullback. Until a bearish cross and pullback happens, you are bullish. I do not need to look at the charts. I'm going to enter in at the first whole number above the pullback. I'm going to compound in every 10 points in this case, every 100 points on a Dow, every $1 on a stock. Again, just trying to give you comparisons depending on where your situation is. But that's what I'm doing. I'm aiming for at least 50% of an average week's move, which in this case is going to be 50 S&P points. That would be 500 Dow points. Again, just to give you a comparison. Again, I'm compounding in. If this works out, if I'm making $1 for every point, I should make 1,500 points compounded. So for every one, if I'm making $1 for every 1 point the market moves, I should make $1,500 with a nice trending move on an average week. I will realize, which means that I actually take it, it's not theory, I will realize some whips, some stop outs, because you can see that the price moved down at this point, but that retracement allows me to buy the dips in an uptrend. So what I can also do is, because that bullish alert has tripped, I can buy down 2610 to 590 to 580. I can keep buying the dip in an uptrend mechanically and get in at better prices. So in this case, price retraced. It didn't come down to 25.90. It did come to 26.10. So 2610 was the eventual start point, and it's 50 points from the lowest point. So as price gets to 2610 plus 50 points is going to be 2670. So right up to there, there's your 50-point move. Stephen, I'll come on to that in a moment. With Dana, my apologies if I'm not pronounced it. I'm going to go with Dana. You're in at the round number. So again, just going back over here on the left, 2620 is the whole number. I'm going to enter at 2621 with a stop loss that's 3 points at 2618. If I get in and I'm stopped out, I will replace the order at the same level. That's what I would class as a whip or stop out. So Stephen, first of all, 3-point stop loss gets hit. Mechanically, this is why it's a mechanical trading method. It's a tight stop loss. I'm going to replace the same entry with the same stop loss, the same position size at the same level. I'm buying, Dana, I am buying bullish at that point there. Let me just highlight a different color. At this point here, that's where the new direction has tripped. At that point, the cross, the pullback, and the confirmation has happened. I've got in at my first entry at 2620 level, and I've been stopped out. At that point, I am in at every round number, and if price retraces, then I get to buy the dip in an uptrend, because we've already established it now officially, it's in an uptrend. But I get to buy the dip in an uptrend mechanically without looking at the charts. I can place my orders in advance. I don't have to do it at the time. I'm going to buy on a limit order at the whole numbers with 3-point stop losses until a new direction is confirmed. So yes, to be fair, Michael, I'm referring to CFDs, spread betting stocks. All of the entry methods require an entry and a stop loss and a target. As I mentioned earlier, we're not covering the use of options for this training program. If you want to use them, by all means, you have the ability to do that, but that's not the focus of this early stage of the trading challenge. Stephen, the target, 50 points, there's your target. So the 3-point stop loss, take profit, you're getting in at the whole number. So eventually, as you're buying the dip down here, 2610 is the round number that got you in. So you're in at 11 with a stop loss at 08. You're going to compound in every 10 points, and you're going to target, you're only going to compound in 5 times, and you're going to target 50 points. Add 50 points to 2610, and that gives you 2670. So up here is your 50-point target. That's your average expectation for the week. Let me just catch up on the question. So Stephen, 3-point stop loss, but you take profit. Yeah, it's not scalping, Stephen. You're using in fairness, you're using a scalper type entry mechanically without needing to use the charts. So that's what this is why I refer to it as a shotgun entry method. You're going to get in, you're going to get stopped out. You're going to get in, you're going to get stopped out. You're going to get in, you're going to go to the next level. You're going to compound in. When you do, if you work out the numbers, how many times would you, if you're going to make 1,500 points, multiply that points by however big a position size you're trading. If you're making $1 for every point with compound, you're going to make $1,500 on the movement when you hit targets. How many times would you need to be whipped? How many times would you need to be whipped just to break even? So let's think about, to be fair, let's think about a worst case scenario. How many times would you need to be in and stopped out? That's the whip. How many times would you need to be whipped to only break even when you hit targets? I'm going to swear, if it offends you, tough. It's a fucking big number. You've got to be in and out and whipped a lot just to break even. Now, typically, you can be whipped several times. I'm not going to lie to you. It's a shotgun entry method. This is the downside to it. You will get in and stopped out, but you're going to be risking a very small number. We've not covered per trade risk yet, but it's small number. It's a 0.5% of your trading account. For me, at the moment, that works out to be about $3. I'm going to lose $3 every time I'm stopped out. I'm going to make $1,500 every time I hit, my apologies, on the price. I'm going to make $150 every time I hit targets. At my current position size, I'm going to make $150 and I'm going to lose $3 for every time I'm stopped out. That's a good deal. What I'm trying to highlight is it's going to take a lot of whips, which are very frustrating, to lose $150. So if you hit targets and you've been whipped a lot, it's going to take a lot of whips just to break even on the position. Now, typically, you're going to realize a risk, meaning that you've been stopped out several times, worst case scenario, between $30 and $50 on average. That's the worst case scenario. Best case scenario, 7 to 10. It's going to happen. I'm not going to lie to you. You will get whipped. Best case, 7 to 10. Worst case, 30 plus. You will still make money. Between $30 and $50 realized loss, worst case scenario, make $150 when it hits target. And on average, in a typical week, we know that will happen. Yeah, you can see the map. Great, Steve. Perfect. Great. I've said it a few times though. So Stephen's, yeah. Everyone's kind of, I'm just going to pause here, just make sure everyone kind of thinks about this. They're just kind of ticking it over in the mind maybe. Wait for the cross. Well, here's Dana. Here's the thing. If you think that, who was it? Peter mentioned earlier. If you want to trade through and get an early position on next week's move, again, I'm not saying don't do it. I'm just saying usually it's not worth it. If there's enough room for the week to continue to move, There's further potential for the week. You might only be through half of an average week's movements. You could see another 50 points in the week. You can take profit at your first 50-point targets, and guess what you're going to do? You're going to carry on. It's a mechanical entry method. So if you hit target here, you've cashed out your 50-point move. You can, again, the following week or at the end of Friday, you continue. You're going to be in at 70, 60, 50, 40, 30, 20. As long as the direction doesn't change, you carry on. It's a mechanical entry method. You are bullish. You are buying the round numbers. Every round number, you are going to be buying. You're going to be placing your entries and your stop losses, and you're always going to be aiming for 50 points. You're always going to be compounding in every, in this case, 10 points. 5 times, take profits. Start the process again. In at the round number, 3-point stops, 50-point targets. Compounding in every 10 points. It's a mechanical approach. Does that make sense? Catching up on the comments. So, Diana, yes. So you're always going to get out at targets, and you will ride it as well. So you cash out, start the process again. Cash out, start the process again. You're not going to do anything different unless the direction changes. So until a new direction develops, you are bullish. There is a mechanical entry. You know where the next entry is. If the market goes up, you know where the next entry is. If the market retraces, you're going to buy the dip in an uptrend. You know where the next entry is. Does that make sense? And this is why you don't need to, as long as the direction doesn't change, you don't need to look at the chart every day. I know where my entries are. It's the next round number. I can place those orders on a Monday, all of them. And my targets, I can have them all placed. Yeah, so absolutely, Jad. So at 26.21, you would place your first entry with a stop loss at 26.18 in our example over here on the left. So that's our example. So you get in at 26.21, stop loss at 26.18, 3-point target, and I can place the orders in advance at 31, 41, 51, 61, 71. No, just buy one. You'll buy one at every level. You'll have a total of 5. You're compounding in. You're not going to buy 2 and then 3 and then 4 and then 5. You're not compounding the position size. You're just compounding the position. In fairness, Jared, you will have 2 positions at the second level, but you're not going to add 2 more and then 3 more and then 4 more. You're not increasing the position size. It's the same position size. I know I'm being a little bit weird on the answer there, but I just want to make sure that you're not increasing position size as well. You're just adding to the position. That's mechanical entries. That's the shotgun method. To be fair, Alan, I was referring to the whips as being stopped out. I'm going to assume that you mean how many times do you compound in? I'm looking for a 500-point move because I want to compound in. This is why I'm looking for an instrument with price volatility. If I didn't have price volatility, I would not be able to use this method. That's correct, Dennis. So it's not a trailing stop loss. Sean, I wouldn't compound the position size when you take a new entry. So when you've hit targets and your account justifies an increase in position size, then yes, we'll cover that in a moment. I wouldn't automatically at every compounding point, increase position size. I would consider the trade from first entry to the final targets. When that's ran to its conclusion, no position will be on. I would then reevaluate my position size at that point. I wouldn't automatically compound position size. That said, you're going to put one entry level at one level, another one at the next entry, another one at the one after that. You're going to compound in 5 times. Again, let's just assume it's one share for the moment. One share at every level. And you're going to do that 5 times. Yeah, I know. I mean, to be fair, I wouldn't compound the position size in that way, because if you think about it, you're going to get to the second point. You could end up having an entry that was worth 0.5% times 5. You're going to have 2.5% per trade entry at the last point. It doesn't make any sense. Stephen, yes. So a question from Stephen. So you're absolutely right. You can set up all the entry when you know the direction. There's my little drawing tool. So when you know the direction, so we're looking at this point here that I've highlighted in red. At that point, that's your first entry level. So you've got your cross, you've got your pullback, and you've got your confirmation. At that point, your first entry level has been triggered, Stephen. You will know every number 5 times above that, and as price retraces, you will know every whole number below that. So you can place all of these orders in advance. The only time you need to do something is when you're stopped out. The only thing you need to do is replace the order that was just stopped out. So if I was, for example, if I was in at 26.10 and I was stopped out, I would replace the order at 26.10. So in at 26.11, stop loss at 26.08. If that's stopped out, I'm just going to replace the order. In at 26.11, out at 08. It's a 3-point stop loss. If that gets stopped out, guess what I'm going to do? In at 11, out at 08. At the net, and again, you do that. I'm doing that at every whole number. So at 26.20, 26.30, 26.40, 26.50, 26.60, I'm cashing out after a 50-point move. I'm going to compound in 5 times, one share at every level with a target of 50 points. I'm going to make 50 points on the first entry, 40 points on the next entry, 30 points on the next entry, 20 points on the next entry. I'm going to cash out all of those and make 10 points on the last entry. With compounding, you're going to make 1,500 points. And you don't really need to look at the charts unless a direction change has happened. Again, we'll stay here as long as we need. Believe it or not, the discretionary entry method's a little bit easier. I think what confuses the issue sometimes is the compounding element. This is an aggressive entry method, but it's also a mechanical entry method. I don't need to look at the charts. It's got advantages. I'm compounding aggressively into a big movement. Disadvantages, it's tight stop losses. I will get whipped. I will appreciate very small losses. But those losses are far overshadowed by a large margin because of the compounding. Absolutely, Peter. At every level, you're going to be risking a very small amount. And to be fair, if you want to risk more, if you want to risk less, that's fine. I don't know how deep your pockets are. I don't know what your risk tolerance is. Personally, it's a 0.5% risk. Again, if you want to trade small, again, another advantage of CFDs is you get to trade small. You get to trade small position size. If you want to trade with ETFs and stocks, you can trade one share, literally one share. Again, just pausing here. That's it. Yeah, yeah. No, but Michael, go for it. We've not actually gone on to the discretionary method, so we've not moved on. So we're still talking about the mechanical entry method. I'm happy to kind of start at the beginning and run through this one more time, if that makes sense. Does everyone want me to kind of just run through the example one more time? Unless there's a something question. Would that make sense? Does everyone want me to do that? Yeah, okay, let's start off at the top then. Because I think when you get this, you'll be quite surprised. I mean, again, I'm not going to deny it's aggressive. It's mechanical. It works. It's going to make, it does make a lot of money. This is, for those of you who remember my old trading room, this is a method that we used during the collapse of the financial markets, because it was because the markets were so fast moving. You need volatility for this method. I think before I actually go through the example, I think it is worth just pointing out, you need price volatility for this method. This does not work with low price volatility instruments. This would not work on USO, a $13 stock. It's not suitable for low volatility instruments. You need high volatility. That's why I'm trading the instruments that I'm mentioning. And that's why we used the ATR tool earlier to figure out, does this have high volatility? Does this have low volatility? If I'm looking for a 50-point move, I need to see a 100-point move available. I want to be able to capture at least 50% of an average week's move. And maybe this now explains why I was pointing that out. If I'm looking for at least 50 points on the S&P, I'm looking for 500 points on the Dow, and the average movements is twice that. So if I'm going to trade Facebook, I'm looking, because I want to compound 5 times, I need at least $5 move. I need to see at least a $10 move on average. That's why we were looking at that ATR to make our evaluation earlier. Now, because of that price volatility, this mechanical entry method can be used. Yeah, I think I just answered your question as you were typing it there, Michael. So yeah, my goal is to make 50% of an average week's move. I also want to be able to compound in 5 times. So I need at least a 50-point move on the S&P, a 500-point move on the Dow, a $5 move on Facebook. So I need at least twice as much as what I'm looking for to profit from. Now, if you don't have that, or you don't want to compound in the way that I've mentioned, we'll cover that with the discretionary entry method. So don't worry about it if this doesn't make sense or you're nervous about using it. Because again, it is aggressive. You are going to appreciate whips and you're going to get stopped out. But that's overshadowed by the potential rewards. And that's okay. And if you're not sure about a volatile instrument, again, don't worry about it. The discretionary method's got your back. We'll cover that in a moment at this next step. Anyway, so with that said, let's go through the mechanical entry method start to finish. Let's go through it. So we have the cross. So that's our step number 1. Wait for the cross. Oops. Wait for the cross. And then we're going to, step number 2, trade the pullback. So we need the push. We need the pullback. I think we're all happy with the pattern itself. My entry is going to be above the pullback high. The pullback high is 26.13. I'm going to use the first whole number above the pullback. So all I'm going to do is round it up to the nearest whole number. In this case, it's going to be 26.20. So that's my whole number. I'm going to compound in at 26.30, 26.40, 26. Oh, I can't even spell numbers today. It's been a long day. 26.50, 26.60, 26.70. 1, 2, 3, 4, 5. So my apologies. That's the targets. So I'm going to compound in 5 times. with a 50-point target. So that's my aim for the trade. And I know that all in advance. So I'm going to use the whole numbers above my trigger, the pullback high. So the example for the entry, for the position sizing and actual entries, let's use the first one, 2620. I'm going to enter at the just above the whole number and stop loss just below the whole number. So I'm going to enter at 21 with a stop loss at 18, and it's a 3-point stop loss. So that's how I'm going to use the whole numbers. So enter at 21, 31, 41, 51, 61. Out at 71. 50 points. When the first entry has been triggered, I can start to buy the dip. Now, I might not get the dip. I might not get that retracement, but I can utilize it if I want to. So as the first entry at 2620 is triggered, the mechanical entry method gets tripped. So I can start to buy in below the market and buy the dip. 2610, 2600, 2590. So I can start to buy the dip. And again, I know these orders all in advance. When I've got an entry and you start to see the movements, again, in this case, 2601, that first entry there, that's going to be the lowest point of the move. I can add 50 points to my first entry because I'm looking for a 50-point move. So I start it at 2620, but if I get that retracement, I'm going to be buying in at a lower price point. Whatever that is, again, as price starts to move, you'll know. I can start to set my target. So in this case, 2600. I think I used 2610 in the previous example. My apologies. But 2600. So in at 2601, add 50, 2651. So there's the, let's use the thing there. So we're aiming for that 50-point move, and I'm going to compound in every 10 points, and I'm going to compound in 5 times. I'm going to add 1 share or 1 contract or $1 points every 10 points with the same 3-point stop loss. And I'm going to take my profits at plus 50. So I'm going to close the entire position at plus 50 because I'm looking for a 50-point move. If it makes sense, I can continue to buy. I can continue that same entry program. Typically, I normally leave it till the following week. But if it makes sense, you can certainly continue the buying program. But it's a mechanical entry method. Yeah, and you absolutely, Dana. You continue to do that until there's a new direction has been confirmed. Dana, you don't have to worry about the close of the bar. That's the beauty of this. Once you've got that direction over here, you don't need to look at the chart anymore until there's a new direction. And that can take between 1 and 3 days. So only when you get a new direction confirmed do you need to kind of check the charts. When you've got that entry method, at this point, I'm bullish. I don't need to look at the chart anymore. I'm going to enter every whole number above my pullback high, the trigger points. And it's just mechanical. If I get in and stopped out, I'm going to replace the order. In, stopped out, replace the order. In, stopped out, replace the order. Compound in 5 times. I'm going to take profit at plus 50. Again, 50 S&P points, 500 Dow points. It would be $5 on Facebook. Again, just trying to give you some comparisons. And it's a mechanical approach. Again, I don't need to look at the chart. As long as I can just replace the order through the day, that's it. That's all we need. Peter, I don't. How many stop out levels? There's no abandoned ship with this. Again, typically on a good trade, you're looking at 7 to 10 whips or being stopped out. A bad trade might be between 30 and 50. If I'm risking $3, or if I'm risking $1 per trade, let's keep the numbers simple. If I'm risking $1 per trade and I'm stopped out 50 times, I've lost $50. If I'm going to make 150 points on the S&P, then I'll make $150. So I'm at the worst case scenario, in my experience, I've lost 50. When the trade works out, I'm going to make 150. So there's no abandoned ship. There's no bailout clause with this. Again, it's aggressive. It's not for everyone. It's mechanical. It makes a shit ton of cash. For me, it's worth it. This, again, just to underscore, this only works on high price volatile instruments. We're going to go through a discretionary method. I think we'll move on to that just next. But essentially, it's great for high price volatility. It's great entry method. This is what I'm using. If that's not for you, the next method might make sense. If you want a little bit more relaxation, you don't want the high blood pressure, you're worried about the stop outs, it makes sense. Whew. Did we get it? Does that all make sense? Shotgun entry method, mechanical. Yeah, and absolutely, Stephen. Yeah, it's literally, you can set this up at the beginning of the day, the beginning of the week, in fairness, over the weekend. If you know the direction. The only thing that you need to do when you've set it up is replace an order. And on a new signal, if you're getting a retracement, to place a few orders below the markets so that you can buy the dip. But the reality is the only thing that you need to do is to replace an order if you stopped out. Yeah. And to be fair, for me, me personally, if the market's a little bit whippy, which it was last week, all you're doing is replacing an order. You're not checking into the charts. You're not changing direction. If the market's not moving, then no new signal is going to develop. So you don't need to worry about looking at the charts. It literally is stopped out, replace the order. Oh, hit target. It is very low maintenance from this point of view. Again, this is the method that I'm using. Again, for the reasons I've mentioned, I do like price volatility. I like being aggressive, but as we've already established, that's not for everyone. Right, that's mechanical entry methods.